I think our portfolio is set up in a way that we are less impacted than some of our peers because most of our sites are residential and not fly in, fly out. So Mungari in Western Australia is the site that we probably got the most pressure. And of course, with the potential for that state to open up soon, which will be great, there is the risk of COVID spreading through WA and causing even an exacerbation of these issues. So we are preparing for that. We're confident we can manage it, but our turnover rates are not increasing very significantly. It's more attracting new staff to the business that we're struggling like our peers with.
Hey, Jake, Martin here. Let me quickly jump into the question. I know it's apples and oranges, but earlier this morning we were talking to the folks over at Freeport there. And I mean, there's some overlap, right? Because they're big dog in copper, but they also do gold. And their earnings about 3 weeks ago, one thing we noticed was missed top and bottom line, but costs were going down. Prices were going up. They've got pricing power, therefore margins are expanding. Can you say the same thing?
What we can say is that with Ernest Henry now fully owned by us, that copper byproduct credit is going to mean our cost profile does go down. And that's why we're forecasting a very strong second half to our financial year and beyond that, because copper as a byproduct, it's a great asset, a great commodity to be in. And so we are looking at that. We are using our pricing power with Ernest Henry coming into the portfolio to improve our cost control. But you know, there are pressures in the sector. We're not completely immune to them, but we are working hard to try and contain them.
Jake, a couple of questions, if you don't mind me throwing them at you. Where are we in the commodities, excuse me, super cycle? And is the pricing environment currently conducive to large-scale consolidation and M&A, or is it more suited to bolt-on acquisitions? And have you got a steer on the demand signals coming out of China?
Look, I'm very optimistic about the gold price. You know, unfortunately, we are living in an environment where geopolitical pressures currently are focused on Ukraine and Russia, but really right through the world. I think the Fed has a very challenging job in landing on a very small runway they have to bring inflation under control, and that's where gold shines. So I think gold has a really good outlook at the moment. Consolidation in the sector has been a thematic in the gold space for some time. We've been quietly going about that over the last 24 months. Really, it's been the core culture of our organization and strategy. We look for assets that are maybe less important in the majors. We look for strategic opportunities. We're consolidating our ground positions. We're putting ourselves into really geologically very prospective ground positions. A small portfolio of highly concentrated quality assets is what we're about. And over the last 12 months, we've really transformed our portfolio to be very high quality and with lots of organic growth opportunities. So from our perspective, we have positioned our portfolio already for this potential upside in commodity prices.